I'm here today to talk a little bit about, I'm going to introduce Symvan, but I want to talk about a few topics close to our heart about why Symvan doesn't charge investor fees, what our performance looks like, what our philosophy is. And what I really would like to talk about, which I think is quite interesting for many private investors, not really getting their head completely around the tax and why they may opt for an EIS fund rather than a VCT fund. Okay. So we started, the principals have worked together since 2005, but we started, myself and my co-founder Nicholas in 2014. And, you know, I don't know how many of you remember the EIS market at that time, but it was basically what they call an asset-backed market. And basically you just invested for the tax. And so the tax is pretty attractive. You get 30% of your money back, both with EIS and VCT. And we'll get into some of the other things like the loss relief. But the promise was, give me £1, then I'll give you £1.05 back or £1.10. We thought this is ludicrous because when you look at the tax breaks, particularly loss relief, we thought someone's missing a trick here. You know, if you look, and we'll get onto the portfolio in a second, but if you look at most private client portfolios, they're kind of, you know, stocks, bonds, cash, looking at a 6-ish% return over this cycle, maybe 7 if you're doing really well. Of course, some years you do really well, some years like last year, not so well. But we thought, you know, this should be the part of your portfolio that really generates alpha, what hedge funds used to promise to do, and the odd one like Bevan Howard did last year. But, you know, we think we can get an IRR, a return of 285 per £1 invested. Baked into that assumption is that we have 40% failure. We've had less than 5% failure since 2014. Now, what typically happens in venture, the old rule of thumb is a third fail, a third do okay, and a third do really well, and maybe one outlier that makes you 10 times or more your money. So since when I used to get up on stage and talk about 285, people used to like, whoa, you know, like treat you one as if one was a madman. And now everybody in the market is talking like this. So you saw that we won a few awards and whatever. Probably the top rating agency is a group called Allenbridge, who rate different fund managers. As you can see, some of those names you probably know. Some of them are university spin-outs like Mercia and Parkwalk spin technology out of universities such as Oxford. MMC has been around for 30 years or so. Molten used to be known as Draper SV. So these are, you know, there's 60, 65 EIS funds. These are the ones they rate. So you know, when we first started, we were, despite having many years of tech experience and large investment banks and IPOs, we were kind of at the bottom of the list, and we're close to the top now. So within tech, what do we invest in? Well, simple, really. I mean, you know, there's different buckets here. It's probably easier to say what we don't invest in. University spin-outs, consumer tech like wearables, social media, etc., or life sciences, which is a very interesting area, but very specialized. What we look at is B2B, both enterprise software and for SMEs, which has one big disadvantage, which it takes a long time to get into, like, say, a big bank or a KPMG, etc. But once you do, the CapEx is very low, there's recurring income, and we have quite a bit of expertise in that area. So here's what, you know, I used to work for big banks like Merrill Lynch, Deutsche Bank, used to deal with major IPOs. Nick used to run the Autonomy, which became the most successful UK tech company. Well, we went all the way back to very early stage, seed stage. And one of the main reasons we did this is because to have more of an influence. I think one of the things about venture that's so different from other types of fund management is you're really involved, you're on the board, you're hands-on, and we have quite a lot of experience and can really add to the companies. But the other great thing about this is that if you get in at the you know, an early stage, because of preemption rights, you can follow that all the way up. So for instance, Revolut, if we had been lucky enough to get in to Revolut at an early stage, and they were an EIS fund, you could get them on crowdfunding actually not too long ago. You could follow all the way up through Series A, Series B. And so you de-risk what is a risky proposition. We'll get onto the tax, which is even before, which de-risks it even further. So you might remember this guy, the known knowns, the known unknowns, the unknown unknowns. The known knowns is really what we know, and that's the tax. So, you know, those funds I showed you, if you go into any of them, you know, the tax is certain. The tax treatment is the same for everybody. So what is the tax treatment exactly? Well, and I do an example here of EIS versus VCT. Both of them you get 30% off. So in other words, if you put 100 pounds in, you get 30 back. But I've highlighted in yellow the differences, although I guess the first difference is you can put up to $2 million a year into EIS. So that sounds crazy high amount, but a lot of people who invest in EIS have sold businesses, for instance, and they don't want to defer capital gains. So you see at the bottom there, can you defer capital gains? You can with EIS. No, you can't with VCTs. Loss relief. What does loss relief mean? Well, if I put 100 pounds into a company or a fund and I get 30 back both through EIS and VCT, but if a company goes, say in worst case, it goes bust, I get roughly about another 30% back, depending on your tax situation. You don't get that with VCT. Now, bearing in mind that you get failure in venture, that's very attractive in terms of your overall after-tax return. But there's also something else which is much beloved by financial planners, which is carryback. So, for instance, we just finished the last tax year about a week ago. We know this because we're extremely busy the last few weeks before that. But a lot of people are looking for carryback to the previous year because they can offset their tax. So they might have a capital gain or they might have income. And finally, and often overlooked, there's the second from the bottom here. It's called business relief. This means EIS, if you hold it for over 2 years, is a business relief product. In other words, it falls out of your estate for IHT planning purposes. Okay, so that's the known unknowns. Well, so we know what the tax looks like. Now the question is, what manager or managers do you choose to invest in? Well, let's talk about, there's two things that manage, fees and performance. Let's talk about fees. Typically what happens in the market for many providers, not all, and we're one of the not all, is that if you put 100 pounds into a fund, 10% is taken off the top. And that's a mixture of establishment fees, and they typically take 2% AMC up front. Now, Symvan doesn't take anything. We'll talk about that in a second. So there's two advantages. One, for 100 pounds invested, if you have someone who charges investor fees, you only get tax relief on 90. But not only that, their portfolio is 90 pounds, mine's 100. They're going to have to really outperform to beat me at to the finish line, if you like. So what do we do? How do we survive? On thin air or just performance? Well, we do take performance. It's the only thing we take off an investor. So, in other words, if you gave us 100 pounds, we turn it into 200, we take 80. Right? So pretty straightforward, nice and transparent. Our thing and where we've really disrupted the market is fee transparency. We take fees, 6% from the companies. So the company, we buy 100 pounds of stock for 94. We reserve the right, depending on the amount of due diligence, legal, technical, etc., to take up to another 2%. Now, what happens in the market, we went through the previous slide talking about people who take off of investors. Well, everybody also takes off investing companies. But in the IMs that you look at, they have little small print because the FCA will punish you royally if you take fees off an investor and don't disclose them. That doesn't apply for taking off investing companies, which is fine because it's an expensive asset class. You know, you're a director on a company, you're doing a lot of work, and boy, do you do a lot of work with some of these guys. But our fees are totally transparent, totally. Now, you think fees, 2% a year, does that really matter? Well, what we refer to fees as the carbon monoxide of the fund management industry. So here you can see 2% fees per year. Now, this isn't anything up front, right? So not the 90 up, the 10% up front. 2% per year. This is modeled on a typical wealth management product, a DFM, which is the classic stock, bonds, cash, where you're looking at a 6% per year, maybe 6.5% over a 30-year period. 49.5% at 2% per year. 49.5%. That doesn't include inflation. So you start asking yourself, even with fairly innocuous 2%, that's quite a hit. So, let me just see how we do for time here. As we know, the last 18 months have been a complete disaster in the tech market. Probably stopped about 18 months ago. It started in the US and it quickly spread here. And it was about time because there was a massive bubble. And I think, usually you'd argue that early stage technology investing is uncorrelated to traditional asset markets. I will make an exception for this one because zero money, free money essentially, zero interest rate environment that we were in for a long time essentially had people first going to major asset classes like property, large cap stocks, but the amount of money that came into venture, and it was compounded by a lot of American money coming into the European venture, the sheer weight of money caused outrageous valuation, which still has not completely disappeared, particularly at the very early start of the market, the very early stage of the market. But having said that, and believe me, if you had seen me speaking 2 years ago, I was in the fairly demanding task of asking people for money, but telling them the market was overvalued. And we really had a lot of companies walk away from us because it's pretty hard when someone will pay 3 times what you will. Now, I was on a year-end kind of all-star list that I do every year with Hardman Research. Some of you may know them. And myself and a guy called Neil Cole, who's head of alternative investments for UBS, we're talking about the B word. So this is about a year and a half ago. When's the bubble going to burst? And I believe one of us quoted Warren Buffett about when the tide goes out, you see who's been swimming with trunks and who hasn't been. And I think that's what you're going to see with a lot of venture. You're going to see a lot, with a lag, a lot of companies are going to fail. A lot of people are going to find that, people were paying literally 3 and 4 times what we were. But out of times like this is when you can really make money, right? You can really make money. If you look at previous times that the world seemed at an end, 2009, look at the companies that started then. WhatsApp, Uber, Slack, Square. The next year, Instagram. A few years later, 2015, our very own Revolut started. And a year ago or so, it had a $33 billion valuation. And I forget which 2 high street banks, maybe it's NatWest and one of the others, combined market cap equivalent to Revolut. So these companies, and that wasn't EIS, as I mentioned earlier. You could have invested that using EIS. So let me talk in my remaining, I think I have 7 minutes, 5 minutes. The name of the game with this kind of investing is exits. It's not a listed market, so there's no liquidity. But then there aren't with most of your investments. I mean, I've lived in the same house for 25 years, probably the most central London, most successful or significant investment I've had in those years. You need liquidity in part of your portfolio. There's a part that is more important to focus on long-term return. And this should be seen as a long-term return. But at the end of the day, what you want, and it's another advantage over investing in VCTs, is with a lot of VCTs, there's a lot of old companies there. You ask, why are they still there? We look to exit companies within 7 years, or an average of 7 years. Some might take longer, some may not. But I'll give you an example of some of the companies that are potential in our portfolio to exit. The first one is a company up there called RUVR, which is immersive technologies for enterprises. They have a who's who of enterprise clients, anyone from Amazon to Amex. So they basically do learning and make the content really cheap. Learning through immersive technologies is a lot more efficient for enterprises than PowerPoint. Sweetbridge is a company actually we've got 3 people talking about buying them. And, I mentioned, I can't get into too much detail, but I mentioned our target is $2.85 per £1 invested. That's going to exceed that. Writing Them is a company that we actually we virtually sold it to private equity, to an insurtech company. These guys, you might have seen, if any of you use AA and you have a car accident, you'll use our claims management software is Writing Them. What they basically do, and it's really kind of the core of our philosophy, is they reduce the cost of claims, which is a huge part of insurance. That goes straight to the margin for insurance companies. So some of the largest insurance companies use these guys. They are also someone who I think someone is going to pay up big for. But the only reason we did have, we were selling for $50 million, and the deal fell apart on December 23rd, 2021. Private equity guys tried to change the terms at the last minute, which is not completely unknown, and we said thank you very much. We have plenty of other suitors. Cognisys originally spun out from Cambridge, uses, as the name suggests, cognitive science through gamification to help enterprises hire people. Another company, we've had people approach us, but we haven't had the right price yet. By the way, the Writing Them, the $50 million, our first investment was at a valuation of $1.2 million. So we had IRRs of up to 800% on that. And I think we'll get something like that similarly But what I briefly, in the last 2 minutes, I want to talk about Custodiex, a Manchester-based company that potentially, now I should add, all of these can also go bust. It's a volatile market, but potentially can make many, many times our market. You might have heard about the crypto winter, but you may also have heard that a lot of digital assets get stolen. In fact, 20% get stolen. And like cash or bearer bonds, once you lose it, it's gone. It's like dropping 100 quid in the bus, it's gone to whoever picked it up. What Custodiex do, now bear in mind, crypto is, it's important, but peripheral, really. Everything's going digital. You might have seen Larry Fink from Blackstone. If you go on our website, you can see it, the article, actually on my LinkedIn, and he's talking about the entire fixed income market and equities going to be digital assets. But thus far, no one has solved the problem of how you can secure those assets and transact in the kind of volumes that are needed. Custodiex does that. Custodiex is going to be a company you guys are going to hear a lot about, or we're going to sell it to someone, one of the big custodians in the world, and you won't hear about it. You'll hear about them. But I hope I've given you a flavor of what we do. We've got a booth just across from the JP Morgan booth. But so come across if you want to discuss any of this. Be glad to share my thoughts. Thank you very much.